Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Connon, along with Brianna Valesky, and we have Mark Yusko on the line. He's a CEO and CIO of Morgan Creek Capital Management down there in Chapel Hill. How's the weather down there?
We got whacked a little bit, although, I'm not a southerner, so it looks like a little dusting to me, but they've shut down the whole city for 2 days because we got a half inch of snow and ice. But it's
boy.
cold. It's cold.
Okay. Little quick, your education and background here for our listeners.
Yeah, so grew up in the endowment business, worked at University of Notre Dame, and then ran the endowment here at University of North Carolina, Chapel Hill. Then 10 years ago, spun out to form Morgan Creek Capital Management. We're an asset management firm that focuses on bringing the endowment style of management to individuals, small institutions, and wealthy families. Background in actually pre-med of all things, biology and chemistry. And found my way into the investment biz.
Okay, let's talk about the University Endowment Model, and I know it's pretty diversified. I've not had any direct contact with it, but could you just give us the rough outline? I mean, universities have a huge responsibility, a lot of money under their belt. Briefly describe that model for us.
Yeah, and the easiest way to think about it is, an endowment is a unique thing. It's a fund that lives in perpetuity. Meaning forever. All of us have a finite life. A pension fund has people in it that have finite lives, and they're going to spend that money at some point. But an endowment lives in perpetuity, and there are two things that are really important with an endowment. One is that you preserve purchasing power. If you socked all your money away into cash or bonds and made 2% today in bonds, and inflation came back to 3%. You'd actually be losing purchasing power every day. You'd think you have a very safe investment, but you actually have a very risky investment because you're losing to inflation. So big thing is that you have to earn a return above the spending rate. So universities spend about 5%, and so you need to make 5% above inflation.
They spend 5% of their total capital per year for operating expense? I mean, am I...
Yeah, for endowed purposes, right?
Okay.
So, they'll spend it on whatever donors decide to endow. So, I gave money at my alma mater for a scholarship up at Notre Dame. So those funds get spent every year. Now, the subtle difference between a family and an endowment, as I said, most individuals, and all of us, have finite lives, but there are families that have multi-generational wealth. The assets are going to be passed to the kids and the grandkids. And so the same model we think applies in managing assets. So we think that you need to take advantage of long-term investments, also private investments, and alternative investments. So what differentiates, the easiest way to think of big university endowments, the thing that differentiates them is they invest in alternative investments, hedge funds, private equity, real estate, energy, commodities, and by taking advantage of something called the illiquidity premium, something that you get for locking your money up, you get better returns. So that's the fundamental difference.
And, of course, you have to fluctuate with your, proportion of assets to equities. And, boy, we're at, elevated level in the markets. I guess if you look at it for something that, needs to go on for forever. Where are you at as far as your allocation to the equities markets right now?
Yeah, it's a really, really important question. So, we break equities down into really, 4 buckets. You've got the 3 primary developed markets, the U.S., Europe, and Japan, and then you've got emerging markets. Actually, we probably have a 5th bucket because we probably break out emerging markets into truly emerging and then the frontier markets that are really, really developing, early stage developing. So when we look around the world today, we think the developed markets don't look all that attractive. The U.S. is very highly valued. Any way you look at valuation, whether you look at the Buffett indicator, which is market cap to GDP, whether you look at PE ratio, the Shiller Cape just hit the 2nd highest of all time to the tech bubble. Same thing with the Buffett indicator, 2nd highest of all time. So in any measure of valuation, the U.S. is a tough market. And in the absence of QE, which we think drove all of the excess return last year in the stock market, was just the excess liquidity from the Fed. In the absence of QE this year, we think it's going to be tough to make any money at all in U.S. equities. Now, that doesn't mean all. That means the index. But there'll be good opportunities. We'll probably talk about some today. There'll be good opportunities. I mean, VIP Shop is a great example. Announced earnings yesterday, up 14%.
What's the symbol on that?
Huge winner.
Symbol?
Pardon?
What's the symbol on that?
VIPS. VIPS.
Okay.
V as in Victor. And it's not a U.S. company, but it's a U.S. listed Chinese online shopping company, e-commerce company that we love. It's like the TJ Maxx of China. But just stepping back real quick, and I'll finish the answer to the question and get to the next one, which is, we think U.S. is overvalued. We think Japan is actually undervalued. We really like Japan and Japanese equities here, and we think Europe, we're on the fence. If they come through with this QE program in March, like Draghi has promised, although he's promised before and not come through, if they actually come through, then we think Europe will be pretty interesting. I like certain parts of Europe, like the pigs, particularly I like Greece, because no one else does. And then finally, in emerging markets, we think emerging markets are going to do well this year. We think the fact that everybody thinks they're going to do poorly in the absence of QE, we think is backward looking. And then we think frontier markets, places like Africa, look really interesting long term, although the short term it's a little more dicey.
Do you, as far as your U.S. equity allocation, do you try and hedge it all with the futures or options?
No, it's a fantastic question. So I do believe that today you want to be as hedged with a D as possible. So we actually run a number of portfolios. One of them is a long-short equity hybrid fund, where we allocate some money to managers and then we run a portfolio internally of best ideas. But that is very hedged today with a D. It's got about 50% net exposure. And I think the next 3 years are going to look very similar to 2000 to 2002. People think of 2000 as being the big down year. It really wasn't. It was down about 9%. Then the recession started in 2001. Down 11%, but it was 2002 that was the doozy, down 22%, when people finally realized that we were in a recession. And I think the same thing is probably happening here. We're starting to get, early warning signs of an impending recession. Earnings are starting to roll over. As soon as 2015 earnings go below 2014 earnings, people start to get nervous. So we think, this year could be a tough year, kind of flattish to down a little bit. Next year, probably end up in a recession and have a little tougher year. And it's 2017 where you get the really big, difficult period. But in that period, 2000 to 2002, hedge funds actually dramatically outperformed. They were up about 40%. They were up about 10% when the market was down 40%. So a huge relative outperformance. So we do think that now is the time to be more hedged than not.
Okay. You got a lot of things on your plate. I know you're looking at, real estate, a bunch of different alternatives. Do you have any time to look at the charts, or do you just leave that to?
Oh no.
Okay.
I'm a aficionado of all the guys on Twitter out there. In fact, I think that's how we came across each other on Twitter. A lot of the CMTs and guys out there, market technicians, I follow religiously. Stan Druckenmiller was a big user of charts to help him with his fundamental.
So what do you like to look at? What are you, just a bar chart, daily highs and lows, double tops, triple tops kind of guy, or are you?
All of those. Look, all those are important, and the price tells you what the market is thinking. So many people try to guess what the market's thinking, but the price actually tells you what the market's thinking. There's a great quote from Paul Tudor Jones. I actually retweeted it yesterday. That he said that everything he did revolved around the 200-day moving average. When it was above, he was long. When it was below, he was short. And I look at things like double bottoms. Oil made an interesting. The oil stocks anyway made an interesting double bottom here in December and then again in January, and we'll see if that holds up. We're probably on the other side of that belief, but at least for right now, it's holding up. Well, actually not this morning, but over the last couple of weeks. I also like. When you get support of a certain trend, like if you're a short-term trader, you want to watch the 20-day. there was a point from June to December where the crude futures didn't go above the 20-day moving average. That's extraordinary. I mean, that's a serious
That's
downtrend.
rare.
It is rare, and so you have to watch those things. But I do think that you can live in the fundamental world like we do and still respect the technicals.
We're coming into a little bit to the end of earnings season here. We get some of the retailers coming out near the end, and just a couple stocks. I don't know if you want to give a fundamental look or a technical
Sure.
look, but we got Walmart here. That stock's been on a major run, starting to find some support here at the $85 level. I mean,
Yep.
holy smokes! What this is something that you're
Look,
involved in?
Walmart fits into a theme that we have that it's called little luxuries. When gas prices fall, there's no question that is a windfall for consumers. Now they have to choose what they're going to do with that windfall. And the average consumer isn't going to rush out and buy a diamond ring at Tiffany's. That's just not happening. So they go to the pump, they got an extra $20 in their pocket. What are they going to do? Well, a couple things we've seen. One, they've bought some extra packs of cigarettes because Altria is at all-time highs. That stock has just been on a tear. Beer companies on near record highs. Walmart had a big surge here November, December, and we think that people are taking a little bit of that savings and buying some essentials. And Walmart really suffered about a year ago when taxes went up, and we think this is the effectiveness of a tax break. And Walmart is one of those examples that wins there. Same thing with Dollar Tree and Dollar General and the dollar stores. So little luxuries, we think win. We don't think this is really good for the big luxury consumer brands.
Okay, well, that's a perfect segue into J.W. Nordstrom here. It's a good point. The people that have the money to go to Nordstrom and these higher-end places are not going to make their decisions based on a gas tank, but different consumers have different tastes. J.W. Nordstrom here, due to announce this week. He's had a nice run, really been quiet between $78 and the $80 level. Some of these other retails, Fossil got destroyed today. Any participation in Nordstrom? Something in your portfolio? Looking to add? Looking to short?
We don't own Nordstrom. I grew up in Seattle. I shouldn't say I know the Nordstrom family, but I have hung out in places where a friend of mine has a beach house next to one of the Nordstrom guys. But I have incredible respect for this company. I think they are the best upscale retailer in the business. You can see this stock has just been on a tear here, never even threatening the 50-day moving average, let alone the 200-day moving average. And, I think this earnings season has been a little tough on the upper-end retailers, and so there's probably a little bit of risk going into earnings. The market's telling you that a little bit, as you said, kind of here, consolidating.
Correct.
But it's certainly possible that if anyone were going to have a beat, it would be Nordstrom, because I just think they're better at retailing than everybody else.
What about technology? We got Intuit coming up this week as well. And I'm just looking at this stock, and this had basically equal ranges in the last two trading sessions, Nearly identical. Where are you in the technology sector and taking a look at Intuit here?
We're very overweight technology. It's one of the few areas where we can still find growth. And to justify these big valuations, you've got to have growth. Intuit is a very interesting company in that it's something that the everyday person uses, and tax season they use it even more. So it's a good seasonal time for Intuit. It had a very good February, March last year. My guess is they'll probably do pretty well here this year as taxes get tougher and tougher to figure out. But technology overall, we really like what's going on in Silicon Valley, the innovation cycle. We think mobile is just an amazing trend. You think, I marvel here sitting with my iPhone 6 Plus that it does about 10 times more than the first computer that I bought from Michael Dell when he was selling them out of his dorm room back in. I should have saved that as a collector's item, by the way. It is truly amazing what you can do on your mobile phone now. So we think the innovation and the technology around the mobile internet is going to be with us for a while, and big opportunities to take advantage of it.
You mentioned oil and the way you reacted to the 20-day average, and seemed like you'd be getting a little bit of a bounce here in crude. We also saw Warren Buffett is out of Exxon Mobil here. A little surprised at that. Still has a nice yield on it. Did you get caught in this slide in energy? And if not, is there issues that are attracting some interest from you down here?
We had a modest amount of energy exposure early last year. As it rolled over, we cut. We didn't cut all of it at the top. We were a little slow on the trigger there, but today we've got a very low weighting in energy. Starting to think about nibbling around the edges, but we've decided, at least for our clients, to play more on the private side. So we've actually done a decent amount of private investing in energy lately, because we think there's some good ways
MLPs
to play,
or
particularly. Well, yeah, exactly. We own some private shares in natural gas gathering facilities and some pipeline assets. But you mentioned ExxonMobil. The challenge for ExxonMobil, people think of it as an oil company. It's really not. I mean, it is, but it also has many other companies like refining. And refining is just the opposite of E&P, is you want low oil prices, not high oil prices. So it really plays more like a diversified conglomerate. So it doesn't really have as much oily, somebody's looking for oil. A lot of people will buy XLE, and I think that's a mistake because it owns all the integrated, not the E&P. I think XOP is a better way to play if you want direct oil exposure. But these integrated companies, they're great companies to own long term. I think they're tough to trade short term. But if you just put it in, it's like Altria. If you look at that chart that just came out the other day, since 1968 versus the S&P, do the same thing with ExxonMobil. They're just monster stocks to sock away and own forever.
Okay, final thoughts on the markets here. Up near all-time high, showing a little red today. I know you're not a day-by trader or week-by-week trader, but just final thoughts on the market.
Yeah, look, as I said, I think the U.S. equity markets are highly valued. I think that if you're a value investor, it's tough to find things to do here. If you're a growth investor, I still think there are some opportunities, and you just have to make sure you're getting paid for the high level of valuation you have to buy into. Overall, I said we're cautious on U.S. markets. We think they're going to struggle to generate returns. I had an interesting debate with Lee Cooperman down in Florida last week. I got to interview him, and he thinks the market's going to be up 7 to 8%, and I think it could be flat to down that much. And we got into a nice heated debate, and very respectful, but. He thinks that it's business as usual, and we think things are overvalued. And the one thing that we're not really sure about is, will the Fed change their mind? Will they decide not to raise rates? Will they decide to enter QE? If that happens, then the markets will continue to surge because there'll be excess liquidity. So the one wild card, to my view, on a flat market is I heard, I haven't verified this, but I heard the other day that the Fed actually did expand their balance sheet by over $100 billion in January. So even though they say they're not doing any more QE, I guess through repurchases or reinvestments of income or something, they grew their balance sheet. So if that's true, that's worth another 40 points on the S&P this year.
Wow, great point. Mark Yusko, CEO and CIO of Morgan Creek Capital Management, joining us here on Benzinga's Pre-Market Prep. Thanks, Mark. Have a great day, and we hope to talk to you again soon.
No, thanks for having me, and I'll talk to you guys soon. Take care.